What if I told you Toronto's housing slowdown isn't just about interest rates? Behind every for sale sign sitting too long and every cancelled condo project, there's a bigger story unfolding. A story about how Toronto's economy is changing. Because what we're seeing right now isn't just a housing correction, it is an economic reset. Stick with me. By the end of this video, you will understand exactly what's driving the housing market and how to position yourself to get ahead today. Let's start with the numbers. On a national level, the Canadian economy is showing signs of weakness. Second quarter of 2025, GDP was down 0.4%, the largest contraction since 2020. Canada's overall unemployment is at 7.1%, the highest since August 2021. And the North American Free Trade Deal is up for negotiation in early 2026. On a provincial level, as of September 2025, the unemployment is at 7.9%. There are multiple sectors that are under economic pressure. Tariffs are hitting the auto and steel industries. These are good paying full-time jobs in Ontario that are on the line. In the media, we hear about Stellantis, GM, and the Honda battery plant. But forget about the ripple effect of these closures and shift cancellations. It is estimated for every job at the auto companies, there are 7 other jobs that are created. Truck drivers who deliver materials to and from the auto plants, subtrades that service the manufacturing facilities, the parts supplier, manufacturing plants, the local diner where employees grab lunch, and many other small businesses in the local communities. What's been flying under the radar is the quiet layoffs happening in the real estate sector, where developers are shedding employees, subtrades laying off workers involved in building new homes, such as framers, electricians, plumbers, concrete form employees, and many more. On a local level, Toronto's unemployment rate has climbed to 8.9%, the second highest after Windsor among Canadian cities. Now, let's talk interest rates. The Bank of Canada has cut its benchmark rate from the highs of 5% down to 2.25% at the time of this recording. We're back to historical norms for mortgage rates. One would think with rates back to normal levels, real estate sales would bounce back. As Bill Clinton once said, "It's the economy, stupid." It doesn't matter if mortgage rates are zero or mortgages are free if consumers are worried about losing their jobs. Now let's talk about the Toronto real estate markets, which can be broken into 3 sectors. Ground level, such as detached and semi-detached. You have the resale condo market and new construction condo market. I'll leave out commercial and the 905. With respect to new construction, there were only 53 pre-construction condos sold in September 2025. These numbers have not been seen since the early 90s, when interest rates were double digits. The whole new construction industry is frozen, which will lead to more layoffs from developers, architect firms, engineering firms, construction companies, and their subtrades. I'll put the link to a video I recently published where I discussed the 3 factors that need to change in order for the new construction market to rebound. The loss of new development is also a loss for government coffers as they collect land transfer taxes, development charges, levies, HST, and more. 6 to 7% of all Canadian jobs, or approximately 1.2 million jobs, are tied to the housing industry. This includes direct jobs in construction and indirect jobs in supporting industries such as manufacturing of materials, real estate services, design, and engineering. This slowdown doesn't just cool prices, it cools confidence across the entire city. For the resale condo market, it's in a strong buyer's market territory where supply exceeds demand. In October 2025, sales to active ratio was at 18.5%, which is well below the 40 to 60% for a balanced market. With lower interest rates, back to the office mandates, and prices coming down double digits from the peak of 2021, moving into 2026, I believe condo sales will increase. Sales, not prices, which until the supply of existing resale condos and newly completed condos is absorbed, that's when prices will appreciate in the condo market, which probably will take a couple more years. For ground level housing, such as detached and semi-detached properties in the city, these are selling if priced well and in great moving condition. Detached market is in buyer's market territory, and semi-detached is in the balanced market territory. Now, let's follow the money. When fewer homes get built, less properties get sold. It impacts City Hall since Toronto collects its own land transfer tax above and beyond the province. Toronto's land transfer tax alone brings just under $1 billion a year. City development charges for new construction, that's another hit. When new construction market is at a 30-year low, that's millions in lost revenues. Money that funds transit, housing, parks, and police. We're not just talking about an economic slowdown. We're talking about a potential budget crisis. This leads to higher property taxes, which we have seen rise 23% the past 3 years in the city of Toronto, all while households are already stretched. Let's talk about market psychology. Housing markets run on confidence. It is the largest investment consumers make. Buyers are cautious. Sellers want 2021 prices. Investors are parking their money on the sidelines, waiting for favorable conditions. In 2021, fear of missing out drove prices up. Now, uncertainty is doing the opposite. Some first-time buyers are waiting to time the bottom. Investors are calculating cash flow and potential appreciation for investments. Developers are reluctant to launch projects that demand does not exist for. Even people with money are taking more time to contemplate options. When consumer confidence drops, making large decisions stops. Another force is immigration. For decades, Toronto attracted top talent from across Canada and internationally. Those were full-time, permanent, well-paying jobs. Now, many of those same professionals are leaving due to cost of living, high taxes, congestion, and quality of life. Here's the uncomfortable truth. Toronto is at a crossroads. We built an economy around housing, but now housing is slowing the economy down. Developers can't afford to build, supply stalls, governments lose tax revenue, jobs disappear, spending drops. But it's also forcing innovation. Developers are pivoting to purpose-built rentals, and government is incentivizing modular homes. City Hall is reducing some red tape. The province is re-examining taxes that made construction so expensive. The reset is what Toronto needs to rebuild a balanced, sustainable housing economy that accommodates families living in the city. The past 10 to 15 years, prices ran away from incomes. So where do we go from here? This downturn will end, but it won't look like 2021 again, and hopefully it will never look like 2021. Toronto doesn't need more speculative units under 500 square feet. It needs livable communities backed by stable, well-paying jobs. Lower interest rates and lower prices will trickle buyers back in. We're already seeing first-time home buyers come back this year into the resale market where affordability has improved compared to the peak of 2021. Here's the takeaway. Toronto isn't crashing, it's correcting. Back to normal, nice and steady. This is an adjustment period, part of a longer cycle. The market will not reward speculators. We're going back to long-term housing economics of gradual appreciation. The condo market hasn't hit the bottom yet, but we're getting there as the final project completions are coming due in 2026. After that, there is no new supply. It will take a while to absorb the existing resale and newly completed condos. Then prices will rebound. Ground level homes, such as detached and semi-detached properties in the city, are selling if priced well. If you're planning to buy, sell, or invest in Toronto's real estate, the smartest move right now is to understand where opportunities exist. In the current market, I see opportunities for three groups. First group is the first-time homebuyers who can take advantage of high supply levels and normal interest rates. The second group, current homeowners who have outgrown their home to move up the home ownership ladder. They can buy the larger asset for a bigger discount from the peak of 2021. They won't get what the neighbor sold in 2021 for their current home. However, they can buy the long-term home discounted from the very peak. The third group, real estate investors, focused on cash flowing properties such as duplexes and triplexes. There is rental demand for ground level living in areas close to transit in the city. And again, with higher level of supply and normal interest rates, there are opportunities for real estate investors. If you found this video helpful, give it a like and subscribe. If you're thinking about your next move, reach out via the link below. I'd be more than happy to chat with you. I hope you've enjoyed this video, and I'll see you in the next one.